Warren Buffett, also known as the Oracle of Omaha, made history with his successful strategy of value investing. He founded Berkshire Hathaway and they run it better than anyone. They have a huge portfolio including international giants like Coca-Cola, Bank of America, Proctor and Gamble, Mastercard Inc., and Goldman Sachs. He invests in companies, not markets. He's been successful because he chooses excellent companies with a strong track record. Thousands of people would love to mimic his strategy. Have you never invested before? Learning about Buffett's approach to making money might be a great introduction. Please remember, I am not a financial advisor and so nothing we talk about in this video is financial advice but rather my personal opinion. So before doing anything, do your own research and consult with a professional financial advisor. You can find useful links to help you on your journey in the comments section below. What is value investing? Warren Buffett is famously known for his value investing strategy. This involves buying stocks that seem to be undervalued and selling them years later when they're worth what they should be. Market corrections happen often and are generally short-lived. One theory is that, in a correction, stocks are overpriced because the market has reacted too strongly to recent sentiment and media coverage. As such, there should be an opportunity to buy stocks at a discounted price. It's no surprise that this strategy requires a lot of knowledge, both of the market and what your business needs. There can sometimes be complex calculations involved too. It can help to have a look at factors like cash flow, profits, revenue, brand, and market share when determining which stocks are undervalued. Try looking into Benjamin Graham's The Intelligent Investor and Warren Buffett's The Essays of Warren Buffett, Lessons for Corporate America to learn more about the basics. In the meantime, here are some of the basic aspects of Buffett's value investing strategy. 1. Invest in companies you know. A piece of advice Buffett gives is to invest in companies that you know a lot about. In addition, it can be helpful to have an understanding of their business model and strategy. This makes it easier to predict if they'll be successful or not and if they'll continue producing high-quality products. Generally, people already running their own businesses come up with more effective ideas. That's not always the case though. The main thing is making sure to take a reasonable and structured approach that goes above and beyond. You'll want to make sure your company has a strong commitment to success and that it's financially sound too. There will always be risks with investing and you may need to spend a lot of capital. Be especially wary of new startups who get all their cash from other investors. 2. Invest in companies with a competitive moat. A company's competitive moat separates them from their competitors and helps them outperform. Any positive factor that a business has that others don't is likely their competitive moat. It can be called an economic moat, or it could just be a USP known as a unique selling point. What matters is that it works. Other businesses may be hard-pressed to copy your company's competitive moats, like patented products or improved processes. This can give you a real edge in the market. Wide moats are something you want to have in your business. This is because they show that the odds are unlikely for another competitor to come up and dominate your field, like how Google was successful with their search engine once it got the algorithm right. That's one heck of a challenge. There is no surefire way to spot if the company will work. Finding businesses with a good competitive moat takes a lot of research. You need to have experience or be familiar with the industry to know if they have a stronghold over their competitors. You might know that competitor analysis is useful for figuring out how successful other businesses are. But maybe you didn't know that it can be used to identify aspects like their cash flow, what they're most successful at, like ideas, products, or intellectual property, and their unique selling point, for example their brand. 3. Invest in companies with a good management team. When shareholders become a part of a company, they want to know that the management team will look after their interests, as they do with the interests of the company. Warren Buffett explains that this is key when investing. You can usually tell a company's leadership qualities by the way they share profits. Strong, steady dividend growth and evidence of buybacks are usually signs of competent management. It's important to know how good of a place it is to work, not only for staff but also for the long term of the company. Companies with happy staff are more likely to do well and want to stay there. If employees are unhappy, they will want to go somewhere else. So when workers are content and passionate about their jobs, it has a good influence on the company as a whole. Here's another thing to think about if you're into ethical investing. How the company treats its staff will affect what you decide. 4. Invest for the long term. Warren Buffett is an investor who likes to think long term. His strategy isn't about hopping on the latest trend and then selling your stocks after a few months. It's about investing in businesses that you think are likely to be successful, and so generate healthy returns over an extended period of time. Many businesses may take some time to turn a profit, which can initially lead people to undervalue it, but this ultimately ends up being their greatest strength. Long-term investments don't guarantee an instant flow of money, but they provide a slightly higher chance to grow your savings. Though you need to save considerable funds and stay patient, it shouldn't be as intimidating as it might seem at first. 5. Invest when markets are panicking. Stock market volatility doesn't have to just be bad news. History has shown that the effects of spikes and dips usually don't last, so your investing time frame will determine if you're affected. A company with a good performance is likely to survive bad times. Buying stocks when the market is down may also help you find some great investments. It's important to find a company who has a low share price but is still doing well enough to survive long term. A good example of this is the COVID-19 crisis. Many businesses have struggled to keep afloat as a result of this, which put their survival in jeopardy. You don't want to invest in businesses that are circling the drain. 6. Expect to make mistakes and plan around them. Warren Buffett might be a multi-billionaire, but he's not perfect. He says that the dumbest stock he ever bought was actually in Berkshire Hathaway. After a dispute with the company in 1962, he bought up enough shares to give him controlling interest so he could fire their management. He believes it took a toll on his investments, costing him around $200 billion in the long run. Buffett has made many other eye-watering losses over the years, totaling anywhere from the hundreds of millions to billions. These range from the purchase of Dexter Shoe Co. for $433 million with Berkshire Hathaway shares he later sold at a value of $5.7 billion. He didn't offload his shares in Tesco before the company admitted to overstating its profits and its stock went down. Buffett always says when he's done something wrong, helps others learn from his mistakes, and still expects to make more mistakes in the future. New investors can also learn from this. Just because you've had some success doesn't mean you're immune to an unexpected disaster. But if you expect to make some mistakes, you should spread your risk around. This will help you survive the impact when those inevitable mistakes happen. Warren Buffett is a big name in the business world and he's made a lot of people lots of money. He has earned his nickname as the Oracle of Omaha, but it's more to do with his persistence and experience than any kind of ability to predict what's going to happen next. He's also made a few major investments that have lost significantly. He's learned from this and has yet to put more than he can afford to lose into any one investment. If you're not a finance expert, the best place to start is by getting in contact with an independent financial advisor. With so many different possible investment options, they can help you decide the best course of action. Your independent advisor can help you work out how much to invest and figure out what would be a safe investment for you. They'll also make sure that your other finances are in good shape so that when investing doesn't pay off as you'd hoped, you have enough cash flow to sustain things you need to live.